think it's okay to be boring sometimes. Like a financial plan shouldn't be smoking and bursting with fireworks. Like it should be relatively boring.
Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone and welcome back to Blind Spots. Today we are talking about year-end to-dos. So the end of the year is a great time to take inventory on your financial life. And today we're going to be talking about some areas to focus on that we find that are most important at the end of the year.
Yeah, and the genesis of this, Erin, I don't think there's anything more frustrating to me when I talk to a client or a prospect and they're obsessing about things they can't control. They're obsessing about what the market does next, inflation, what's on the news, what have you, none of which they can control. At the same time, there's things they can control that they're leaking oil on. So today, we're going to go through a checklist of things that you can do, that you can control today to help optimize your plan and give you a better chance of success without having an opinion on what the market does next. That's the best part.
Yeah, and I think that this is a great way to just kind of wrap up the end of the year, start fresh with the new year. And like you said, optimize what you can control and take practical steps to make you kind of feel at peace.
That's right. And if we sound like a broken record, know that a lot of what we're saying is our principles. And, we work with a lot of people, we see a lot of prospects, and there's some overlapping themes here, which is why we sound redundant. But it's also good to hammer the message home because we've been doing this a long time. We've seen what works and what doesn't work. And in our opinion, the best approach is to look in the mirror and focus on the things that you can control, because as 2020 showed us, the fourth quarter of 2018, there's a lot of things relating to financial markets that are completely outside of our control.
All right, so let's get started. So at the end of the year, if you are 72 or older, you need to take your required minimum distribution.
Right. So take your RMD, and I know the rules have changed a little bit. So it went from 70 and a half, which was an odd number, to 72. So most of our clients actually defer taking their RMDs to the end of the year because they want to maximize their tax deferred growth. Of course, that only can happen if the market goes up. Lucky for most of us, it has over the past 12 years. So make sure you take your RMD before December 31st at the end of the year, because there's a penalty if you don't, and that's bad. For those folks that are asking about their 2022 RMDs, we have to wait until the last day of the year, actually 12/31 of 21, to calculate your 2022 RMD.
Next thing, at the end of the year, we start looking into tax season. So let's talk a little bit about tax loss harvesting.
Yeah, so this applies to taxable accounts, so your non-retirement accounts. And at the end of the year, we go through all of our client taxable accounts to see what gains that we've realized over the course of a year. So if we bought a stock at 100, it's worth 150, and we sold it, there's going to be a capital gain. So what we're trying to do is look at realized capital gain and see if there's any unrealized losses, right? So say we bought the same stock at 100, maybe it's trading at 50. That's an unrealized loss that we can take. We can sell that stock to offset the gains that we've accrued throughout the year. So our job, the whole lens of this, the whole idea of this is to mitigate tax drag. If we can save our clients money on taxes, that boosts our net after tax returns, which is all that matters. And again, this involves no crystal ball, no gypsy ball about what the market does next. This is just us harvesting the low-hanging fruit.
So piggybacking on helping mitigate taxes, let's look at 401ks, IRAs, HSAs, and contributions to that towards the end of the year.
Yeah. So if you're worried about taxes and you want to lower your taxable income and you're still working, the easiest thing to do would be to max out your employer 401k. And I believe the limits are, Erin, you can correct me if I'm wrong. Is it 19,005
Yes.
for those under 50, and for those over 50, it's 20,500?
24,000. You get an extra 6,000 catch-up contribution after the age of.
Nice. And that doesn't include your employer match. So
Right.
if you're maxing it out, you're getting a match from your employer. It could be well above those limits. So make sure you do that. You'll get a tax break today. It'll reduce your taxable income. That money will grow tax deferred. And then if you have an IRA, like a traditional IRA, depending on your income, it may or may not be deductible, but it's still good to save because all that money again grows tax deferred. And then on the Roth side, of course, that's after tax money, and there's some income limits as well. So if you have any questions about if you qualify for a Roth, quick Google search would do, or you can reach out to your advisor if you're a pure client.
Yeah, the other account that we briefly touched on was the HSA. It's a health savings account. And I think that these are kind of the hidden gem that people don't really discuss very often, but they are triple tax efficient. Money goes in pre-tax, grows tax-free, and then it comes out tax-free as well for any eligible purchases that you make. So if you're in a high deductible health insurance plan, take a look into HSAs as well. Okay, how about gifting to family or to charities at the end of the year?
Yeah, so this could be a double benefit. Like we've had clients actually gift their entire RMD to a charity, which helps lower their taxable income because all of that is deductible, which is nice. So that's a good thing to do at the end of the year if you want to gift to family or a charity to reduce your tax bill. But also, a lot of clients are asking about getting under the estate tax threshold. Yeah. So depending on what state you live, we've had a lot of Washington clients asking about this, where they're trying to lower their taxable estate. And one way to do that is to gift to a charity or family. So work with your estate planning attorney, work with your advisor on coming up with a strategy if you're worried about estate taxes on efficiently passing your assets on to the next generation.
Yeah, and I think that towards the end of the year, in addition to looking at family or charitable gifting, it's also a great time to just reassess your trusts, your estate plan. Things change throughout the year. On average, people's financial situation changes every 6 months. And so taking a look at things like beneficiaries, how your assets flow, are they still going to the right people? Relationships change. So making sure that that's all in check when you're going through that estate plan as well is important.
Yeah, and we're not estate planning attorneys, obviously, but we can help you frame how you want your assets to flow. So if God forbid one spouse dies or both dies, how the assets flow. And then the second part of that is making sure your estate plan reflects what you would want to have happen. And then once we have that dialed in, we can go into an estate planning attorney and they can execute the document.
Yeah, I think working with an advisor is really important when it comes to this kind of stuff, because although we're not, like you said, we're not estate planning attorneys, we can help determine what you want and what you're looking for, and then kind of we can help you speak the language to reiterate what you're looking to do.
Yeah, and I would encourage people to work with a flat fee estate planning attorney. I mean, the worst thing, and I've seen this happen, is someone stumbles into an estate planning attorney's office. They're billed by the hour. They're trying to figure out what they would want to have happen. They want to figure out what they currently have in their estate plan. Do all the prep work up front, because when you do work with a billable attorney or an attorney that bills by the hour, you know exactly what you want to have happen, and they just execute the documents. You save yourself a bunch of time and money. And then, if you work with a flat fee estate planning attorney, the whole billing process is just much more transparent.
Yeah. So while we're on the financial planning topic, let's talk a little bit about taking a look at your whole financial plan at the end of the year and double checking your inputs.
Yeah, so we make sure our clients' inputs, like what their expenses, what their income is, basically what their budget says they're doing, actually lines up with their lifestyle. And where this can become disjointed is when someone goes from working to being retired, right? That's a complete lifestyle shift. They might move, their daily activities are different. So that first year, we really stress, probably the first couple of years, we really stress tracking your expenses for a new retiree, just because of the things that I outlined. Your behaviors, your habits, your lifestyle is different, and it might not reflect what we've modeled in the plan. Just make sure that your budget lines up with what's happening in your life.
Yeah.
Okay, and then the second thing with double checking your financial planning inputs is stress testing your portfolio, okay, within the context of your financial plan. So if you have a financial plan, you've got your investable assets loaded in there, you're probably assuming a rate of return, and we're getting a lot of questions about when the next pullback is coming. And I think it's important to understand, to do the work, to understand your potential range of outcomes before a market event happens. So understanding your risk, understanding how your portfolio behaved during the last drawdown, which was spring of 2020, and really asking the question, are you comfortable with those ranges of outcomes? How did your portfolio hold up during times of stress? And we model several different time periods, several different periods of stress, because we want to understand how your investable assets hold up during a bad market environment and how that relates to the long-term glide path of your plan. Ideally, we don't want our clients to depend on outsized returns to make their plan favorable. It's nice if your plan is successful regardless of what the market does, but it's really important to have that context to make sure your portfolio reflects the way that you feel about risk, and it also fits in the context of your financial plan.
Yeah, a lot of times what we do with clients is we create different scenarios. Like, what if X happens? What if Y happens? What if Z happens? And we have a plan to deal with each of them. And it's kind of interesting to see how these different scenarios will really shake out in the context of your total portfolio.
Well, and some pitfalls I see when people run their financial plans is, one, they assume a above market rate of return, right? So they extrapolate what's happened the last decade well into the future. And I've seen people model 12, 14% returns. And of course your plan is going to look great then, right?
Yeah.
But there's this premise, there's this belief that since the past decade has been so good, the next decade might not be as good. So it's prudent to model not only a reasonable expectation going forward for your portfolio returns, but also modeling lower future returns. Like a plan doesn't need a 30% correction to fall off the rails. It can be a period of lower future returns. Instead of 6% a year, you're getting 2% a year. So make sure you understand your range of outcomes and how your return assumption plays into those.
Yeah, we talked about sequence of return risk in a previous podcast, so we'll link that as well, so you can check that out if you haven't listened to that one yet. But taking into account things outside of just market returns is also really important. Just in this last week, I was running a plan for a client, and we looked at their expenses in particular, making sure that we're tracking those correctly. And so we went in together and said, what if we double your expenses? Maybe that's not realistic, but what does the plan look like if we did that? And the outcome was drastically different, where they were originally ending their plan with, or the end of life, they had total portfolio assets around 2.5 million. When we doubled their expenses, they ended up essentially running out of all of their money just a few years into retirement. And so looking at everything is important.
Yeah. And I think at the end of the day, whether you're modeling lower future returns, a market sell-off, higher expenses, what we're trying to do for people is to build a margin of safety in their plan. And yeah, I've said this many times, but your plan is not going to go according to plan. Like, life happens, the markets change. So make sure you have a cushion, and your plan doesn't need to be executed perfectly with every little detail, because it's just not going to happen that way.
Yeah, I think one of my favorite quotes from you over the last year is that if 2020 taught us anything, it's that your plan is not going to go according to plan. And that runs through my head at least once a day.
Yeah. And there's so many plays off of this, because people tend to always want to do something, and they're always making tweaks, so they want to run these different assumptions, or they want to buy a second home, or they're just always doing something. And I think it's okay to be boring sometimes. Like a financial plan shouldn't be smoking and bursting with fireworks. Like it should be relatively boring. And a lot of folks have come to me about what they should do next. And I think in a year like 2021, where we're coming off the weirdest year last year, and supply chains are screwed up, inflation is running higher than normal, the housing market has gone up, the equity markets have gone up. Sometimes it's a great time to do nothing and just allow your plan and your portfolio to be boring.
Yeah, retirement simplicity is beautiful, as you've said. So in the spirit of simplicity, let's talk a little bit about consolidation and how that can be helpful to not only the client, but to the advisor, to your financial team.
Yeah, so I recently spoke to a prospect that had 5 different taxable accounts. So non-IRA, non-401k accounts, just taxable accounts scattered everywhere at 5 different firms. And from an investment side, one, it's really hard to know what you own and to understand your risk exposures. It's probably hard to reconcile the performance of the assets, like what they've done. But from a tax standpoint, from a logistical standpoint, it's a nightmare for you or your CPA, because you're having to gather 5 different 1099s at the end of the year. Like imagine being retired and having to harvest 10 different 1099s and either do taxes yourself or give them to your CPA. Like that's an unnecessary burden. And for folks that are about to retire, or just folks that don't want to deal with that, I really encourage you to consolidate that into one custodian, maybe 2, and just generate 1 or 2 1099s. It'll make your life a lot easier.
Yeah, we've talked about this before, but once you've reached retirement, that's kind of your point to relax. You don't have as much work, not as many things on your plate. So making things as simple as possible is probably in your best interest. And we've kind of had this conversation recently about not mixing up simplicity with an uncomplex plan.
Oh, yeah. So, well, this is another tangent, but this happens rarely, but when it does happen, it can be frustrating. So some of these financial planning topics can be complex, like when to take Social Security. Should I do a Roth conversion? Should I buy a second home? What happens if my portfolio craters? Some of these topics can be complex. And our job is to take the complex and to present it to people in a simple, actionable plan. Sometimes being simple and actionable can be mistaken for not being complex or being unsophisticated. But the counter to that would be, it's very rare, never would a client come in and say, Nik, Erin, I want you to make my plan as complex and as confusing as possible. No one says that, okay? So don't mistake simple and actionable for being lazy or not doing the work or not being complex. Most good financial planners, most independent advisors are using sophisticated planning software in the back end that accounts for everything. So what you and your advisor should be doing is making sure you're capturing the inputs correctly, which is why we obsess about inputs. Each time that we sit down with the client, we make sure we're capturing their budget and their balance sheet and their tax situation and their future goals and modeling scenarios to help them make better decisions, because money can be emotional. There's a lot of information available. Some of it is useful. Most of it is worth less, which is why we advocate for clients to put up their own filter for weeding out a lot of the noise. But again, don't mistake simple and actionable for not sophisticated.
Yeah, so we'll get back on track a little bit here about year-end to-dos. So towards the end of the year, we talked about making sure that your portfolio reflects the way that you feel about risk. How does a person go about having that self-check?
So we use a risk exercise that actually frames investment outcomes, because risk is one of those things that's like, we all know what it is. Sometimes it's hard to understand that in the concept of an investment outcome. So instead of asking arbitrary questions about, like you've seen these questionnaires, like what would you do if the market was down 15%? A, do nothing. B, panic sell. C, I would buy more. Like that's pretty worthless, because you can't recreate human emotion with a survey like that. Okay. So what we try to do is show people, hey, if your portfolio lost 15% in 6 months, is that an okay outcome? Like, would you be able to stick to your long-term investment plan? If the answer is no, we need to go back to the drawing board and tighten up the range of outcomes, which usually means selling equities and buying some more risk-reducing assets. So we take clients through a riskalyze exercise, framing their range of outcomes both in percent and dollar amounts, which reflects how much they have invested. And we do something unique. We pull it forward. So instead of saying, could you risk this much over the next 10 years, we pull it forward and ask, are these range of outcomes acceptable over the next 6 months? And that runs counter to what most advisors and how most investors think. We're conditioned to be long-term investors, but we found it's really hard for someone to stick to a long-term investment plan if they don't understand the range of short-term outcomes. So that's all we're trying to do, is pull that forward. And this is less about what the market has done or short-term market noise or market movement. It's more about your situation, your life circumstance. Like, maybe you switch jobs, maybe your income is more risky, maybe you're going to try to retire early. We're more interested in those things in regards to your tolerance for risk versus market ebbs and flows.
Yeah. And I think the other thing that risk questionnaire also takes into account is that, like you said, it's personal. We have your personal total portfolio value in there. And so when your portfolio is actually down 10%, you see that it's dropped to 900,000. And it kind of helps make that 10% come to life. It's not just an arbitrary number. Okay, so moving on to our last to do is to double check your fees.
Yeah, so what you're paying your advisor should not be a mystery. You should know what you're paying your advisor, how often that fee is taken. It should be on your statement. You should also be aware of the cost of owning the assets, right? So if you own mutual funds or some exotic hedge fund, you should know what you're paying that third-party manager, because that's an additional cost that you're paying in addition to the advisor fee. And then on the tax side, check your 1099s for taxable accounts, because I'm telling you, income strategies like dividend strategies, active mutual funds that saddle you with capital gains for doing nothing are killing you from a tax standpoint. Back to my earlier comment, our job is to maximize net after-tax returns. Dividend strategies and active mutual funds are two of the biggest sins that we see in taxable accounts. You're paying a tax bill that is completely unnecessary. And if you're doing that year over year, you're really hurting your overall portfolio value. Like, you're siphoning money off to Uncle Sam, and you don't need to be doing that. So yeah, don't own mutual funds in a taxable account.
We said it before, and then I'll say it again. The eighth wonder of the world is compounding interest. The eighth deadly sin is outsized fees.
Outsized fees and paying taxes when you don't need to. I think, I don't like Wall Street at all, but I think Morgan Stanley said everybody has to pay taxes, but no one said that you need to leave a tip. So knuckles to Morgan Stanley. I don't like your company. I mean, no offense, but that's a different topic, but that's a great quote. So don't leave a tip.
Yeah, that's great.
And then the last thing, 2020 was an outlier year in many ways, but we saw a wide range of human behavior in response to the COVID sell-off last spring. And this was a atypical market sell-off and bounce back. The market very rarely will sell off 37% in 35 days or whatever it was, and then bounce back just as quickly. And I think back to that time, it was a very scary time. And we were on the phone with a lot of clients. It was a unfortunate time to find out how people truly feel about risk. And I think you can get lulled into a sense of complacency when the markets are going up to feel that you're a risk-seeking investor, even when you might not be. So with the swift bounce back of equity markets, people got a mulligan. They got a do-over because most of their portfolios recovered. And I think now is a great time to look back and reflect about how you behaved during that period. What blind spots did you have? Did you make any suboptimal decisions? and really be honest with yourself about the way that you're invested now. And can you take that risk? Does your portfolio reflect the way that you feel about risk? Because this up market, this swift bounce back, one, it's not typical. Two, it's covered up a lot of mistakes and a lot of warts. So again, it's a great time to reflect at the end of the year. Most people might take some time off. Markets tend to be, I don't know if calmer is the right word, but from a seasonal standpoint, markets tend to perform well in November and December. And it's just a great time to have some inner reflection about your own behavior during times of market stress, which I know is tough for a lot of people.
All right, well, that about wraps it up for this week's episode of Blind Spots. The topics that we write and talk about come from investors like you, so send your questions to insight@pureportfolios.com. We also offer free portfolio reviews, so if you'd like a professional investor's opinion on your current portfolio, we'll give you insight on your fees, tax efficiency, risk metrics, and potential conflicts of interest. You can visit pureportfolios.com/free portfolio analysis to learn more. Thanks for listening, and see you next time.